In this lesson, we'll be doing a lesson on the Commodity Channel Index indicator, also known as CCI. So despite its name, Commodity Channel Index, it can be applied to any market. Some of the things we'll be covering in this lesson include the CCI indicator, what it's all about, how it's calculated. We'll be discussing some of its features, how you interpret the indicator, and applications of actually using the indicator. So first up, the indicator was introduced and developed by Donald Lambert back in 1980, and essentially has become a popular indicator and found in most charting packages around the world. CCI is a momentum oscillator designed to identify overbought, oversold levels, or trend reversals in share charts. It is used to measure the strength or weakness of a trend and to identify potential turning points in that trend. In terms of how it's calculated, CCI essentially measures the security's variation from its statistical mean or average price. It's measuring how far have the prices changed or moved from its average. Its calculation looks at the difference between the typical price of the security itself, the price of the share, and its simple moving average, which is then divided by the mean average deviation of the typical price. So the formula itself is quite complex. So what we'll be focusing on in this lesson is more the interpretation of the indicator. Now, some of the settings you can use with this indicator, depending on whether you're short, medium, or longer term. Short-term traders might experiment with 8 to 13 days as the time frame. Medium-term type traders might use 21 to 34 days. Longer term to position type traders might use 55 to 89 days as their time frame for this indicator. The display shown between two horizontal lines compares the current price to the CCI on a separate scale with a central reference of 0. So when we look at the indicator, you'll notice it has a plus 100 level, that is the upper level for the indicator, defining an overbought zone, and a minus 100 level. So this is the lower level for the indicator, defining an oversold zone. We use these two levels to identify how strong the strength of trend really is, but also a possible change in direction with that stock. And this is the CCI indicator being applied to the chart. And you'll notice the plus 100 level as a horizontal line at the top. And you'll notice when the CCI indicator crosses above plus 100, it becomes grayed out. So as long as the line of CCI remains above plus 100, that grayed out section continues. So that tells us, obviously, it's in a strong trend, but potentially overbought in that direction. And the reverse, at the bottom here, you'll notice there's a minus 100 horizontal line that runs through the indicator. And when the line of the indicator gets below that, again, it shadows or grays out, suggesting the downturn or the downtrend of the stock may be oversold, overextended in this current direction. There's also a 0 line, a center line that runs through the indicator. It can be used to confirm reversals in trend, but predominantly it's the plus 100 and the minus 100 levels we use to gauge what the trend is doing and if or not there's a change in trend coming. So interpreting the CCI indicator, when the CCI indicator line crosses above plus 100, it represents a strong uptrend. So as long as the line of CCI remains above plus 100, it's still in a strong uptrend and likely to continue. It's when CCI turns down and or crosses below plus 100, it suggests the market is recognizing an overbought condition and a possible reversal from there. If this happens at a strong level of resistance, it indicates a possible change in trend. Check for confirming price action to obviously confirm the reversal signal. So that could be a breaker trend line or whatever type of reversal mechanism you use to confirm a change in trend. Now, talking about the minus 100 level, when CCI or the line of CCI crosses below minus 100, it represents a strong downtrend. When the CCI turns up and or crosses above minus 100, it suggests the market may be recognizing an oversold level and buying pressure is starting to return. If this happens at a key level of strong support, could indicate a bullish upturn. So always looking for confirmation of price reversal to confirm the start of the uptrend. Okay, so here we've got a few situations where the line of CCI has crossed below minus 100. And of course, when it turns up above minus 100, it confirms oversold, possible rally. However, if this is happening on a trough low that is not testing key support, it can be a reasonably short-term reversal signal and not a terribly reliable major reversal signal. So wherever possible, look for this signal to be in conjunction with a key level of support, then confirm the reversal with a breaker trend line or whatever reversal method you're using in conjunction with this indicator. So the last one there, the line of CCI does cross below minus 100. It begins to shade out, obviously still going down as long as it's below minus 100. And when it turns up above minus 100, it no longer shades, confirms oversold, suggests the start of an upturn. Again, wait for the breaker downtrend line, and there's the beginning of the new uptrend. Bullish divergence, and divergence generally is an interesting aspect to this indicator, and it's particularly powerful with this indicator. So let's start with bullish divergence. This occurs when the share price is making a lower trough, but the CCI indicator is forming a higher trough. So in other words, the chart and the indicator are doing opposite things. So lower trough on the chart, but higher trough on the indicator is a sign it could be slowing down, losing momentum in its current direction, and maybe reaching a point of exhausted selling pressure. Always look for support, resistance, and confirming price action to suggest the start of an upturn. So here we have an example of lower troughs being seen on the chart with equal to higher troughs being seen on the indicator. So whether it's equal troughs or higher troughs, it's still considered to be a type of divergence. And it's essentially suggesting the downtrend is slowing down and losing momentum. And of course, don't act on any of these sort of signals until we have confirmation of a new uptrend getting underway, which could be as simple as the break of a downtrend line in this case. Bearish divergence is obviously the opposite to bullish divergence. This occurs when the share price is making a higher peak in the uptrend, but the CCI indicator is doing the opposite, forming a lower peak. So interpretation of this, divergence is suggesting the market is currently losing momentum on the upside and may be reaching a point of exhausted buying pressure, possibly ready to top out. So again, we check all this for support and resistance, look for confirming price action to confirm the start of a downturn. So here's a couple of instances of bearish divergence happening in uptrends. So higher peaks on the chart, lower peaks on the indicator. So suggesting the uptrend was actually slowing down, losing momentum. Again, higher peaks on the chart, lower peaks on the indicator. So uptrend is slowing down and losing momentum. Always confirm the reversal with a breaker trend line or some other reversal method, so you're very confident of the change in trend getting underway. A little exercise you can do at home on the CCI indicator. Apply it to your charts. Compare the indicator to support and resistance levels on your charts and assess the signals it's giving you at those key levels. Hope you enjoyed our lesson today on CCI, Commodity Channel Index.